Hello investors, today we're diving into 5 dividend stocks currently near their 52-week lows. We'll analyze their potential as value investments, remembering that, as Benjamin Graham taught us, price is what you pay, value is what you get. We're on the hunt for those hidden gems, those businesses with solid fundamentals that the market might be temporarily undervaluing. So, let's roll up our sleeves and get to work. Our first contender is Intel, INTC. Now, Intel is a name synonymous with computing, but lately it's been facing some strong headwinds. The stock is hovering near its 52-week low, and for good reason. Their recent earnings reports haven't exactly been inspiring, and the company is grappling with some significant challenges. One of the biggest concerns is their foundry business. They've been losing ground to competitors like Taiwan Semiconductor, and regaining that lost market share won't be easy. Another factor weighing on Intel is their exposure to China. The ongoing trade tensions and the global semiconductor shortage are creating uncertainty, and that's never good for business. But let's dig a little deeper into the financials. One metric that raises a red flag is their gross profit margin. It's taken a significant hit, and that's something we value investors always keep a close eye on. On top of that, Intel is pouring money into capital expenditures, trying to upgrade their manufacturing capabilities. Now, investing in the future is essential, but it does put pressure on their profitability in the near term. The question we need to ask ourselves is whether these challenges are temporary setbacks or signs of a more fundamental weakness in Intel's business. Next up, we have Cisco Systems, CSCO, a stalwart in the networking world. Unlike Intel, Cisco's stock price has actually seen a slight uptick over the past year. However, it's still trading relatively close to its 52-week low, which piqued our interest. One thing that stands out about Cisco is its solid return on invested capital. It's a sign that management is effectively using the company's resources to generate profits. That's the kind of efficiency we like to see. However, Cisco's revenue per share growth has been rather sluggish. In this business, growth is king, and Cisco hasn't exactly been setting the world on fire in that department. But let's not overlook the dividend. Cisco offers a healthy dividend yield, and they've got a decent track record of dividend growth. For income-oriented investors, that's certainly a point in their favor. When we look at Cisco, we see a company that's not exactly a high-growth dynamo, but one that's financially sound and shareholder-friendly. The key question is whether their core networking business can deliver sustainable growth in the years ahead, especially as the tech landscape continues to evolve at a rapid pace. Now, let's talk about CVS Health, the corner drugstore we all rely on. Their stock's been under the weather lately, down significantly over the past year, and their recent earnings haven't exactly been a tonic for investors. One thing that jumps out is their return on invested capital. It's not exactly what you'd call robust. See, when I look at a business, I want to see them using their money wisely to generate good returns. That's how you build long-term value. And right now, CVS has some work to do in that department. Now, I know what you're thinking, but Warren, that dividend yield is mighty tempting. And you're right, it is high. But here's the thing about dividends. They're only truly valuable if the underlying business is healthy. A high dividend can sometimes be a red flag, a sign that the market is worried about the company's future prospects. Think of it like this. If a company is paying out a lot of its earnings in dividends, that means less money is being reinvested back into the business to grow and improve. It's like trying to run a marathon by only eating candy bars. You might get a quick burst of energy, but you're not going to build the long-term stamina you need. So when it comes to CVS, we need to look beyond that tempting dividend yield and ask some tough questions. Can they improve their return on invested capital? Can they innovate and adapt to the changing healthcare landscape? Can they create lasting value for shareholders? These are the questions I'd be asking myself if I were looking at CVS. Remember, investing is about looking for value, not just chasing yield. Sometimes the best investments are the ones that require a little patience and a willingness to dig deeper. Now let's talk about Gaming and Leisure Properties, or GLPI. It's a real estate investment trust, a REIT, that focuses on, you guessed it, casinos and gaming properties. They own the real estate, not the operations, which is an important distinction. Think of it like owning the land a casino sits on, not the roulette wheel or the blackjack tables. GLPI's stock price has been holding relatively steady over the past year, which in these volatile times might be considered a win in itself. And why is that? Well, folks, people like to gamble. It's a simple fact of life. And casinos offer an escape, a chance to try their luck and maybe, just maybe, hit it big. Now, GLPI benefits from this enduring human behavior because they have long-term leases with some of the biggest names in the gaming industry. These aren't your fly-by-night operators. These are established companies with a track record of success. And that translates into consistent rent payments for GLPI, which is music to any landlord's ears. And speaking of music, GLPI boasts a high dividend yield, which means they share a good chunk of their earnings with shareholders. That's like getting a little bonus on top of your investment. But remember, just like in gambling, there are no guarantees in the stock market. GLPI's business model, focused on the real estate, not the casino operations, provides a degree of insulation from the ups and downs of the gambling industry. They own the land, and people always need a place to roll the dice, so to speak. Now, let's talk about a company you've definitely heard of, Pfizer. They're a pharmaceutical giant, a household name, and they've been in the news a lot lately. Their stock is currently trading at, well, you can look that up yourself, but the more important question is, what's the company's health like? Pfizer had a pretty decent year in terms of earnings, but there are some things that make me raise an eyebrow. Their gross profit margins have been declining, which means it's costing them more to produce their products. And in a competitive industry like pharmaceuticals, that's something to keep a close eye on. One area where Pfizer is placing its bets is oncology, the fight against cancer. It's a huge market, and if they can develop successful treatments, it could be a real game changer for the company. But developing new drugs is expensive and time-consuming, and there's no guarantee of success. Now, Pfizer does offer a high dividend yield, which might attract income-seeking investors. And they've got a long history of paying dividends, which shows a commitment to sharing profits with shareholders. But remember, a dividend is only as good as the company's ability to earn money. So is Pfizer a buy? Well, that's for you to decide, but here's what I'd say. Look beyond the dividend. Examine the company's fundamentals, their earnings, their debt, their future prospects. Investing in a company just for the dividend is like marrying for money. It might work out, but it might not. Well, folks, we've covered a lot of ground today, from chip makers to casinos to pharmaceuticals. We've seen companies facing challenges, companies with strong track records, and companies looking to the future. Remember, these are just a few examples, and this isn't personalized financial advice. Before you make any investment decisions, do your own homework. Read about the companies, understand their businesses, and consider their prospects. Investing is a long game, and it's best played with a clear head and a well-researched strategy. Please leave a comment, like the video, and subscribe to our channel.